Hey yo, what's up everybody? Good day to you all, ladies and gents. Welcome back to Matrix Investing, the #1 YouTube channel that is dedicated towards giving you education based on investing in capital markets. Now in this video we're going to look at the statement of financial position as well as its components. Now if this is the very first time you're watching our videos, we advise you to check out our previous videos so that you can have a better understanding of what exactly we're teaching. But if you also find this video very helpful to you, we request of you to like this video, subscribe to our channel if you haven't, and hit that notification bell so that YouTube gets to notify you each time we get to upload new videos into the platform. Now with that said, ladies and gents, let's get down to business. So then, what is the statement of financial position? Now this is a financial statement that shows the assets of a business and how these assets were financed. Were they financed through the capital that was invested by investors, or were they financed through money that was borrowed from people or organizations? Now, such statements happen to show the capital invested, liabilities owed, and assets owned by a business in a specific period of time. So then the statement of financial position is prepared after a certain period of time, depending on how the business feels like after how long it should prepare it. So then, the components of the financial statements. Now there are basically three main aspects of the financial statements, that is the assets, the capital, and the liability. So then, starting off with what assets are. Now, assets are basically properties that are owned by the business for the sake of using them to create revenue. Now, assets could either be directly involved with revenue creation, such as the use of machineries, the use of motor vehicles, so that they're used to acquire resources or raw materials or goods that are there to be resold. And then these assets are used to acquire such resources, and machines are there to manufacture or produce raw materials and transform them into goods or services that are to be sold off to the public. So then basically assets are either directly involved with the operations of the business, that is producing or having the main product available for sales in order to create revenue, or the assets could be indirectly involved with the business's operations. That is, these assets are used to create extra income of which could not have been created from the business's day-to-day operations, such as investments in shares or real estate or bonds. And say the business has something completely different to do with these three investments. So then if the business had these three assets, they would either be producing dividends, rent, or interest payments, of which are, say, different from what the business mainly does, which is, say, acquire income through the sale of a certain product. So then, let's look at what the type of assets are. So then there are two types of assets. The first one being the non-current assets, which are assets that a business expects to own for more than 1 year of operation. Now, such assets are usually difficult to sell in the process of trying to convert them to cash. So then, basically, non-current assets are assets that the business expects to have them around for more than one financial year, and in the likely case that, say, the business were to go bankrupt, or the business needs some cash to pay down some debt, or the business just needs, or then we just need to see how much assets the business has in comparison to its liabilities if we sold off all the assets and paid out the liabilities. So then, that is where selling of an non-current asset comes into consideration. So then, as far as selling non-current assets is concerned, it is usually not very easy to sell them in comparison to current assets at market price. This is because you have to find the buyer of that specific non-current asset who is in need of that specific non-current asset, and the niche, depending on the type of non-current asset itself, the niche of that particular market could be small. So then anyways, the main point or the main concern is that these sort of assets are usually harder to sell in order to convert them to cash in comparison to the current assets. Now, examples of such non-current assets are buildings, furniture, long-term investments, and intangible assets. Now, intangible assets are basically assets that we cannot see or touch, such as brand, such as copyright. So then these are intangible assets. Now, current assets are assets that a business is expecting to own within a financial year. Now, such assets are easier to convert to cash and have such a short lifespan in the business because it is expected that within the year, the assets are going to be spent, sold, or completely finished. So then these current assets are basically assets that the business expects that within 1 year span of time, within 1 year, the assets are either going to be sold off, or the assets are going to change in value, they're going to be spent off, and all that stuff. So then the business expects to have them within 1 year, and that's it. And like I told you, in comparison to non-current assets, the current assets are actually quite more easier to convert them to cash because they're easier to sell off. So then, giving you examples, there's cash in bank. So then it's just a matter of you going to the bank and withdrawing all your money. So then there's debtors, or in what is like accounts receivables. That's how they're specifically termed as in accounting. So then debtors, all you have to do is like tighten up your conditions. All you have to do is talk to the debtor from time to time, remind him that there's payments due, and boom, that person pays up the money. Inventory of the business. This is usually closing inventory that is found at the end of that time of which the statement of financial position is being prepared. So then the inventory, basically goods that are remaining in the business that are to be sold off. Now these are quite easier to sell off compared to machines or computers that the business has in huge numbers that are supposed to be sold off. So then it's easier to sell off inventories. Others might be unpaid amount of money. Say there's someone else who hasn't finished down a payment in towards this particular business. Then that amount of money that is due is also a current asset. For example, let's say a customer bought a product from the business worth 1,000 shillings, and the customer was able to pay off 800. There is still 200 due that the customer is supposed to pay. Now that 200 is basically owing income. It's basically the amount of money you are owing the customer. So then the customer has to pay you that 200. So then that 200 that 200 is also termed as a current asset. So then this is basically all about assets. Now let's check out what the liability side is all about. So then what are liabilities? Now liabilities are basically, this is an amount of money that a business is obligated to pay to its creditors or its lenders. Now there are two types of liabilities, that is the non-current liabilities and the current liabilities. And the non-current liabilities are basically debts that a business expects to finish paying for over more than 1 year. Examples of such non-current liabilities are long-term loans, issued corporate bonds, and deferred tax payments. So then basically this is an amount of money that yes, the business is supposed to pay, yes, the business is obligated to pay, but referring to the large sum of money and the way the cash flow is, how the money is flowing in and out of the business expects to finish off paying this amount of money that it is owed for after, or it's going to take more than 1 year to finish off paying. That is, the business is trying to take into consideration that yes, I have to pay out this money, but then also I should consider the amount of money I'll have flowing in the business so that it can be used in operations that are used to create revenue, which in turn make profits. So then this is basically why we have debt that a business is supposed to shrug off, that is going to take more than 1 year to shrug off. Now examples are long-term bank loans. That is, if a business took a huge sum of money and basically the business and the bank realized that according to the bank's position or according to the bank's ability, it will not take a year to finish off paying that loan. It's going to take more than 1 year. Then there is issued corporate bonds for businesses. So then, like I told you in the previous videos, one of the very first videos, there are two ways that an investor could raise funds, that is through issuing of shares or issuing of bonds in the capital markets. Now then, bonds is basically when the business goes up to investors, borrows their money for a fixed agreed period of time, with the promise of paying them interest every annual within that specific period of time, and at the end of that specific time, the business is supposed to pay back the original amount of money to its investors. So then that amount of money that the business has borrowed from the investors, to the investor, that is an asset; to the business, that is a liability. And if it's a bond that is taking more than 1 year, then that is a long-term liability. That is a non-current liability, or a long-term liability. Now, the third one is tax deferred payments. Now then, basically, this is the amount of money that the business had previously not paid to the government, or had previously skipped its payments. So then, if you cumulatively, or if you combine all of these tax payments that the business hadn't paid throughout all financial years, if the government realizes them, or if the business realizes them, whoever realizes them basically, and that amount of money is basically supposed to get paid to the government. Now, so then that amount of money, depending with the complexity of how much it is, if it's a huge sum, comparing it to the business and how it flows, then that amount of money could be expected to get paid off for more than 1 year. So then, yeah, that's basically deferred tax payments, tax deferred payments. So then there's current liabilities. Now, these are debts that a business expects to finish paying within 1 year. Example, short-term bank loans. That is, a business has borrowed amount of money from a bank, and that amount of money is little, and depending on the business, the way the business flows, then it's probably going to take a year to finish off paying the loan. Then there is creditors. Now, these are people, or in accounting, they're known as accounts payable. Now, these are individuals or organizations from whom which the business has bought goods on credit. So then if the business has bought goods on credit, that is a purchase, but it's not a cash purchase, but rather a credit purchase. So then there is going to be a purchase, yes, but then you have also created some sort of debt that you're supposed to pay. Now, this debt falls under the category of the creditors, or the accounts payable, of whom which the business is supposed to pay money back to. And then there's the accrued payments. So then this is basically when a business hasn't finished paying a certain amount of money. Say if a business bought something for 1,000, had paid 800 down, there's 200 remaining, 200 that a business is supposed to finish paying, then that 200 shillings is an accrued payment. The business is supposed to finish that off. So then that falls into the category of current liabilities. There are more other current liabilities, such as bank overdraft, which is basically when the business spends more money in its bank account than what there actually is. So then that's an example. That's another example of a current liability. Anyways, let's get on to the third part, which is the shareholders' equity. Shareholders' equity is the amount of money, cash, or money worth, that is, let's say, assets that have been contributed to the business by proprietors, contributed by investors to either start up a business or scale up an existing one. Scaling up means growing a business. So then, components of shareholders' equity. So then, shareholders' equity could be found as several components. It's been split through several components. One of them being the share capital. Now, this is the amount of money that a business receives as capital due to issuing of shares. So, when a business is issuing shares to the public, here's what's happened. A business, when issuing shares to the public, there's a certain amount of money. This is especially when the business is an initial public offering. That is when a business has just started out, or when the business, it's its first time getting listed in the stock exchange. So, the share capital, like I told you, when a business is going for the public, there's a certain amount of money that the business is expecting to raise from the public. There's a certain amount of cash that the business is expected to raise from selling shares to the public. Now, so then that amount of money multiplied by the number of shares available gives you the share capital. So then let's say there are 100,000 shares, and the business expects that each share will provide 25 shillings. So then that's 100,000 times 25, that is 2.5 million. Is it 2.5 million? Yeah, I guess. So then that 2.5 million shillings is the exact amount of money that a business is expecting to raise from issuing of shares. So then if the business happens to get that 2.5 million shillings, that 2.5 million shillings goes down to the share capital side of the shareholders' equity. Now, second aspect is the retained earnings. Now, this is the accumulated amount of profits after dividend payments that a business has been earning from previous years that has been reinvested back into the business to fuel its growth. So then let's just hit rewind for a moment. Let's go back to when we were talking about the income statement. So then there's revenue, then there's cost of sales, then there's the gross profit, then there's the additional income or expenses, the operating expenses. So then we're just going to go down with that flow, then boom, we get to the net profits, the profits made during that particular time. So then we're always focusing on an annual basis. So then the profits made per year. So then once we reach to the net profits or the profits made in the year, there are two main places where that profit could go. Place number one is back to the investor's pockets. By that I mean to paying dividends. So then it could go, some of it could go into paying down dividends, and the remaining amount goes back into is reinvested back into the business. So then once this amount of money is reinvested into the business, it is already capital. You're investing cash into the business. What happens when you invest something into something? That something that is invested is basically capital. So then once this remaining amount of profits is reinvested back into the business, that amount of profits is now recognized as capital. But in what form? It is recognized in the aspect, or it is recognized under the name of retained earnings. So then, if a business has been making profits simultaneously or continuously or throughout its operations, having some of it little by little, or having a good portion of its profits reinvested back into the business, so then over time, we end up having a very huge figure in the retained earnings part. So then retained earnings shows profits that have been reinvested into the business for over a long period of time. If a business has had 10 years worth of operations, and in all those 10 years the business had been making profits, and in all those 10 years there was a good portion of the profits that was invested back into the business, then on the 10th year we expect to see retained earnings showing a certain amount of profits from previous 10 years that have been reinvested back here. But then that is after dividend payments, of course, because basically the dividend payments, the amount of money that is paid out as dividends to shareholders, is usually cut off the retained earnings. So let's look at reserves. Now, this is the amount of money that is set aside by the business to cater the business against unforeseen challenges that could have negatively impacted the business's operations. So what happens? Now, we all know that running a business is risky. There's tons of risks. There's tons of challenges that are there, some that are predictable and some that are unpredictable. Now, in both cases, a business isn't just going to sit down and then a challenge pops out like pap, and then the business is like, and then the business out of nowhere has to start taking care of that challenge, or has to like get rid of that problem. And the business it will have to go through expenses, and the biggest expense of all being the business having to use the money that is dedicated towards providing goods or services that are in turn to make profits of the year. So then if a business has to meddle with the money that is in the operations, in its main activities, then that business is going to have problems with making goods and services. That business is going to have problems making profits. There'll probably be less profits recorded. So then that business is going to go through a tough time just because some challenge had been there, some challenge that could have been avoided in some other smart way. So then the smart way is the business sitting down and identifying all its risks and all the challenges that are likely to occur. some being listing down all the predictable ones, and having set aside money to cater such problems if they were ever to occur. So then after every period of time, a business sets out a small amount of money to these reserves, a small amount of money, a small amount of money. So then in case these problems ever appear, then the business is like, we've been expecting you. Deploy all the resources that we've been reserving, deploy them to take care and get rid of this problem. So then that's basically reserves. And then there's also the other type of reserve that is kept by the business to take care of problems that are unforeseen. Let's say the building of which the business is operating just happened to split in half, just like that, like pop. So then the business would probably have a reserve that was there to cater for such challenges that the business had not expected of completely. So then this is the importance of reserves. It's basically there to cater off these other problems that could have affected the business operations. So then instead, thanks to the reserves, the business can focus on solving these challenges, leaving its main activities or main operations unharmed. And then lastly, we have the share premium, which is the amount of money received by a company for a stock issue exceeding its face value. Now, what is face value? Remember let's refer back to the share capital. Now, in the share capital, giving you the same example of the company issuing shares for the very first time in the stock market. Now, I told you that by assumption there are 100,000 shares, and those 100,000 shares, each one of those shares, the business had identified each one of these shares worth 25 shillings. So then that's what the business had identified. Now, when the business issues these shares to the public, it expects to get 25 shillings from each and every single investor. But then in the likely case that the share prices the share prices go high. So then let's say instead of each share being worth 25 shillings, the shares are now worth 30 shillings. So then an investor pays out 5 shillings more for each share to own that particular company. Now, that extra 5 shillings, or that extra amount of money that was paid out by investors to own these shares, now that extra amount of money is what falls into the share premium. It gets into the share premium, which is why we say this amount of money received by a company for a stock issue that exceeds its face value. So then that amount of money that has exceeded the expectations, or that has exceeded the expectations of the business, is the amount of money that it's supposed to gain from investors. So then that excess amount of money, that excess amount of capital, is basically share premium. Now, let's all check out what a financial statement, or what the statement of financial position looks like in real life. So then let's move on to it. So then, looking at the statement of financial position, this was prepared by the company TCC, Tanzanian Cigarettes Company, for the financial year starting from the 1st of January to the 31st of December 2018. Now we have the list of all the assets, non-current and current, which makes up the total assets. We have the equity and liabilities. So then equity and liabilities have been put on one side and assets have been put on the other. So then we have all of these as far as 2018, and we have another section for 2017. Now, the reason why they put both years is for an investor to make sensible comparison between the current year and the previous year, and to see how the business has performed as of the current year in comparison to the previous one. Now, looking at these figures, so let's say property, plant, and equipment. Now, it is actually read as 98,117 million. Now, why is that? Because if you're to check up here, right below the 2018 year, there's TZ shillings in millions. So then all these figures here are in millions. There were 6 zeros that were omitted for the sake of simplifying the recording of these figures. So then when you're doing your analysis, or when you're performing your decisions, or when you're basically screening through these financial statements, Just remember that most of these numbers are actually have 6 zeros that are leading after them. So then we have the assets, we have the non-current assets there, such as property, plant, and equipment. We have current assets such as inventories, income tax assets, trade and other receivable bank balances. Then there is equity and liabilities. So then the first starting up, there is capital and reserves, which involves the share capital, defined benefit reserve, retained earnings, and then we have the non-current assets liabilities, which comprises of deferred tax liability, defined. So then all of this, basically, if you'd like to know more about what these individual assets or what these individual liabilities or what this individual equity, if you want to know more about them, what they're all about, you can always check out the notes. So then the notes are prepared after the financial statements have been prepared. So then after all the 4 financial statements have been prepared, what follows after that is the notes to the financial statements. So then the notes are divided in numbers. So then all you have to do is head on to the notes, say you're interested to knowing more about the property, plant, and equipment. So then you head on to notes number 12, you check number 12 out, you'll find the property, plant, and equipment, and you'll figure out what has the business done or what is comprised of this 98,117,000,000 shillings worth of property, plant, and equipment. So another thing I feel like I should be stressing on is the relationship between the assets, equity, and liabilities. So if we remember the definition earlier this video, we said the statement of financial position shows how assets were financed. And there are 2 main ways as to how the assets can be financed. They can either be financed through equity, which is capital invested, and the liabilities, which is borrowed amount of money. So then, as far as accounting is concerned, assets is always equal to capital or equity or shareholders' equity plus liabilities. So then the total amount of liabilities added by the total amount of equity that is available in the business should be equivalent to the total assets. So then as far as how this statement of financial position works, it will show you the assets, it will show you the total assets, which is 266,614,000,000. So then as one side, then the other side you have the equity. They will give you the total equity, and then there's the liabilities, there's the total liabilities right there. So then once you take the total equity, which is 190,194,000,000, with the total liabilities, which is 76,420,000,000, if we add those two, we're going to get the same 266,614,000,000, which is equivalent to the total number of assets that are there in the business. So then this just indicates that these two, equity and liabilities, have got something to do with financing and bringing into existence all these assets we see in this particular business. And this is how the statement of financial position actually works. You have to balance. There has to be an equivalent amount of money. There has to be an equal between the assets and the combination of the equity and liabilities. So then that's how this statement of financial position works. We'll get more into it. We'll get into more understanding of the relationship and how this relationship between assets, capital, and liabilities can be of use to us investors. But for now, let's just take a pause right here. So then, with that said, ladies and gents, thank you so much for watching this video. We believe this video has been very helpful to you all. If so, please help us out by liking this video, subscribing to the channel, share to others who are in need to get this sort of education, and hit that notification bell so that YouTube gets to notify you each time we get to upload content onto the platform. Now, if you're on other social media platforms such as Instagram, Facebook, and Twitter, we are also available. We are there. We're popping right there. You can check our account at Matrix Investing. That is who we are in the social media platforms. So then check us out right there. If you have any questions related to capital markets, how investing works in shares or bonds, specifically that one of Tanzania, you can check us out there. Feel free to ask. We're only a DM away. We'll be happy to answer. We upload content daily.